Richard Field had been napping in the back of his Gulfstream, flying to a military airport near New Delhi when his wife Kathy woke him. Henry Paulson, the Treasury Secretary, was on the phone. From his offices in Washington, D.C., some 7,800 miles away, Paulson told him that Bear Stearns, the giant investment bank, would either be sold or bankrupt by Monday. Lehman was surely going to feel the reverberations. "You'd better get back here," he told Field. Hoping to return as quickly as possible, Field asked Paulson if he could help him get clearance to fly his plane over Russia, shaving the flight time by at least 5 hours. Paulson chuckled. "I can't even get that for me," Paulson told him. Throughout the coming year, Americans saw their investments shrink and their property values plummet. At the heart of the problem was something called the subprime mortgage crisis, which continued to ricochet through the economy. It may sound complicated, but it was really fairly simple. Banks loaned hundreds of billions of dollars to home buyers that couldn't pay them back. Wall Street took the risky debt, dressed it up as fancy securities, and sold it around the world as safe investments. If it sounds like a shell game or a Ponzi scheme, in some ways it was. A house of cards, ripe with corruption, greed, and negligence. Bear Stearns, an investment bank synonymous with Wall Street's success, and in the black for 340 straight quarters, was suddenly faced with the prospect of extinction. Their massive investment in the U.S. housing market failed, mitigating powerful executives into unemployment, a fate many other Americans would face in the coming financial crisis. The projected housing wealth had never materialized the way Bear Stearns and millions of Americans projected. Eventually, borrowers couldn't afford loans, leaving subprime delinquency rates in the 40s.
I blame overregulation as part of the problem because, for instance, if you were getting an adjustable rate mortgage, the interest rate, you would have gotten 8 different disclosures on how that loan was going to behave over the 30-year life of it. And the average loan file at that time was at least 290 pages of documents that you had to read and execute when you closed your mortgage. It was overwhelming. No human being could be expected to understand all that, could even figure it out. Lenders couldn't even figure out a lot of it. The truth in lending disclosure was so complex that nobody understood exactly how to do it, and any two people might have calculated it 2 different ways.
Lenders and brokers may have felt overregulated by the government, but homebuyers continued to stress trying to understand simple procedures of buying loans.
The one thing he said to me was, "We'll need to get you refinanced within the next couple of years." And then afterwards, when I started reading it, I realized it was really going to be really difficult to refinance the house. Because what I had was a what's called an 80-20 loan. So 20% of it was fixed. It was about $25,000. And then the rest of it, the $90,000, was a adjustable rate mortgage.
The problem that existed in the lending industry is that mortgage origination is seen as one function. The people that originated the loans didn't do the servicing or have any back-end responsibility. They were paid commissions for originating loans, so human beings typically do what they're economically motivated to do. They went out there and started originating loans every possible way they could, because every loan they originated and closed was money in their pocket.
Basically, it's kind of a 3-card Monte trick sort of a thing. That you would sit down at the loan, the whole process would be, at the same time, it would be as if you were in the house for 10 years, already had $20,000 in equity in the house. And so basically you're getting a loan for 100% of what you're borrowing.
You can find millions of blogs and videos about individuals' opinions on how the financial crisis developed and remained a problem for the American economy. Let's venture back and see what really happened.
The Dow is expected to open down 300 points this morning, and this is all because we're waking up to 2 fewer investment banks on Wall Street. Lehman Brothers has filed for bankruptcy, and Bank of America is taking over Merrill Lynch in a $50 billion deal.
The mortgage crisis has now taken down 2 of the biggest names, the most storied names on Wall Street. One of them, Lehman Brothers, right behind me.
At one point, the market fell as if down a well, over 700 points. And with late-day trading here, we're at 689. These numbers, as we said, are still changeable. We could see a close, conceivably, 700 or larger.
The crash on Wall Street shocked the world and devastated the economy for years to come. People watched as their investments shrank from multi-million-dollar bonds to pieces of sand in the dirt. Employment skyrocketed and home values plummeted due to the collapse. But yet, many felt uneasy with the government's decision to bail out the banks. Wall Street used clever tactics to buy and sell assets in the subprime market. Using the financial instrument known as tranching, banks pooled assets into groups based on risk and sold them around the market.
If I had taken microeconomics before I bought that house, I would have been much better prepared for it. Because I learned everything about mortgages, about subprime lending, about down payments, about how mortgage companies sell their, they rate them in different levels, and they sell the more risky levels to other companies to pay off loans.
The people that were buying that debt didn't know what they were buying, and the people that were rating it didn't really understand what they were rating.
Subprime tranching may have been a bit deceiving to the average investor, contributing to the collapse. For example, high leveraged loans backed by poor consumer credit were packaged and sold as if these were actually strong investments. Structuring the subprime loans into a package that classified poor credits as AAA credits gave investors misleading impressions.
I feel like, truthfully, the person deceiving me was the mortgage broker. He knew what he was doing. He knew I couldn't afford that house. Knew it. Because he told me the minute my roommate moved out, I was going to be in trouble. You're telling somebody buying a house. And at that point, I should have probably gotten up and walked out and not bought it. I don't feel like Countrywide, because they tried to help me. Bank of America's tried to help me. I don't feel like they deceived me. I feel like I was sold a bill of goods and I didn't do my homework. Mm-hmm. I think the majority of the blame falls upon, buyer beware.
After the collapse, many protests were organized. One of the most famous was Occupy Wall Street, beginning on September 17, 2011, almost 4 years after the collapse. It was the first time America recognized the global justice movement, running on the slogan, "We are the 99%. Between homeowners and bankers, there are many different stances you can take on why the collapse happened. With such an enormous meltdown, it is hard to say exactly how the crisis came to fruition.
I think what I want to say is that there is no malice in this. There's an absence of malice, and by malice I mean there was no bad intent. It's not as if there were several sinister minds that sat down and cooked up a scheme in order to fraudulently bilk people and the housing market out of money.
And they came up with this idea of, well, why don't we take this big pile of debt and slice it based on risk? And I mean, you know, that's something cooked up in a back room by some really smart guys, but the people they sold it to and the people that underwrote it, I don't think really understood what it was.
I think the intent was to try to have people realize the American dream, to own a home of your own, and to get more and more people in a spot to be able to afford a house in the United States. And with that intent came some very creative financing to try to make that happen, so that they could qualify to get 80% of the value of the house, to be able to get 100% loan on the value of the house and get them moved in and now being a homeowner, which was the American dream.
The American dream encouraged homeowners to buy homes and lenders to make loans, but both parties were, in one way or another, encouraged to make poor decisions.
One of the fundamental things that enable lenders to not make good decisions on the front end is the fact that they didn't end up owning the loan long term. There are quasi-governmental agencies, which you've heard of, Freddie Mac, Fannie Mae, Ginnie Mae, you know, and they're in the business, what's called the secondary market. They buy blocks of loans from lenders like BB&T or someone, a private mortgage broker, might originate loans, you know, with their own lines of credit and things, but they're going to sell those loans to Freddie Mac or Fannie Mae and recoup their money to relend again. So you're in a situation where the person that's originating the loan knows right up front they're not going to have back-end responsibility or accountability for it years into the loan. Now they know that Freddie Mac and Fannie Mae are going to underwrite, look at those loans. They're not just going to take them without studying them, but obviously there wasn't enough effort put into underwriting those loan acquisitions, scrutinizing them. But if I'm a loan originator and I get paid 1% for every loan I originate, or 0.75%, my motivation is to originate as many loans as I possibly can. In any possible way that I can get a loan through, I'm going to do it.
Because of the increased popularity of subprime loans, homeowners were encouraged to buy more expensive houses.
People that weren't really qualified to own a home were encouraged to and incentivized to take part in home ownership.
He actually had a button on his desk that said, "Friends don't let friends get fixed mortgages."
And we ended up moving up until about 1970, maybe even into the early 80s. Only about 60% of the people in the United States owned their own home. And then during the Clinton administration, a lot of incentives and a lot of pressures were put on lenders to make home ownership more affordable.
Incentives coupled with creative financing caused an artificial increase in home prices that significantly outpaced wage growth and the growth of individuals' net worth, which eventually led to unsustainable housing inflation. This was exacerbated by the government's policies, which encouraged home ownership and liberal lending policies. Home prices eventually crashed, people defaulted, and unemployment increased. Today, home prices are on the rebound, wages slightly rising, and unemployment is improving. Some are probably even fearing that the stock market is overvalued, creating another potential bubble in the artificial wealth. Have we learned our lesson as a nation, or is the next crash just days away?